What does retirement look like to you in terms of what those spending needs are going to be? So do we have real expectations of what those travel desires look like for you, what you're spending, and how those translate into your daily life?
What are some steps corporate executives can take to make sure they have a good retirement? What should they do with their deferred compensation plan? Well, here to talk with me about that is Amy Permenter. She is head of corporate executive planning at Bank of America Private Bank. Amy, welcome.
Thank you so much. It's a pleasure to be here to join you today.
It's a pleasure to have you here. I want to start here. You've been doing this corporate executive planning for over 2 decades, I'm told. And what do you think is the single most important action executives should take, say, 5 to 10 years before retirement that separates successful retirees from those less successful retirees?
Absolutely. And I think one of the things to really consider is we should think, what does it mean to be an executive? So an executive can mean anything from someone who maybe is over a department or a division all the way up to a senior leader of a company, someone who is an SEC executive. So they can have very different rules and constraints that they need to abide over time. But one thing that is synonymous with all of them is really taking that step to understand their company benefit. Like most retirees, the company benefits are going to play a significant role in an individual's retirement. But with executives, it tends to be a little bit more poignant because the dollar amount can be larger and there can be more at risk and more that could be subject to risk of forfeiture. So we want to make sure that executives first take that step to know what their benefits are. Having worked with executives for a number of years, they don't always take the time to dig into those benefits and know the details. They know them at a cursory level, which is fantastic if they're taking advantage of those, but really digging into the details. So thinking about their various benefits that may be available to them in retirement, if there are rules related to those retirement benefits that they have to meet in order to be eligible for those benefits.
Yeah.
So those can be a very important step in starting the retirement process so that they can get those source documents, they can look at their equity award agreements and understand what happens to each of those benefits.
Yeah.
Think through, are there special benefits around retirement that could be beneficial to them, like access to or subsidized healthcare? So really taking a dive into knowing what's on the palette and available to them is quite important.
Yeah, I do want to talk about healthcare more in a bit, but there are 2 benefits that I think sort of come top of mind when I think about executive compensation and planning for retirement. One would be deferred comp plans, and the other would be concentrated stock positions. Maybe talk first about deferred comp plans and what folks need to know about that.
Deferred compensation is something that people tend to participate in with a light decision. It's a great tool for them to defer taxes. And sometimes they approach that without a real strategy in place for how that's going to complement their overall retirement plan. So, taking that deep dive, looking at those distribution elections and understanding how those come into play. And if they don't fit the current retirement plan, are there opportunities to change those distribution elections? Typically, that is going to involve having to push out the earliest receipt of those by at least 5 years, but that may enable you to change both the form and the timing of those payments. So, whether it's going to come out to you as a lump sum at retirement and have a big tax implication, or whether it could come out in installment. So, looking at your both your work state and the state in which you're going to reside during retirement can be important because the structure of those deferred compensation payments can have big implications on the state income taxation of those benefits. So we
Yeah.
want to be thoughtful about it. If you live in Florida and are moving into New York, we might want to take a different approach than if you were living and working in New York and hoping to retire in Florida, and how we would want to set the distribution elections for those. But
Right.
it's important to really incorporate those distribution elections as part of the overall plan and not treat them as separate, kind of separate decisions. And
Right.
often we make a decision election like that, we set it, we forget it, we let it continue year over year. And as that balance gets large, it can have significant implications on both the cash timing during retirement as well as the taxation that we want to be thoughtful around.
Right. And when you think about these elections, you mentioned it shouldn't be done in a vacuum. I think about like all the other things that could happen to someone. Maybe there's a Roth conversion, or maybe RMDs start, and all of a sudden you move into a different tax bracket because of all this. People need to be conscious of that, I think.
Absolutely. And oftentimes, when people leave at the executive level, they have got equity awards that are going to continue to vest over their early years of retirement if they meet all those rules of retirement. So they may have cash flow coming in that they didn't model in their early retirement calculations in the form of these stock vestings. So whether it's stock or cash coming in, there's income coming in. So maybe they don't need that deferred comp in the first few years. Maybe it's 4 or 5 years out when that really becomes important, and giving you that opportunity, as you suggested, to bridge that timing between retirement and then when you first begin taking your distributions from your retirement plans.
Right. And so many executives, when they retire, may also have concentrated stock positions in which they need to think about their entire asset allocation, and maybe they're overweight in their company stock and now need to perhaps reduce their exposure to this single company risk. What advice do you have there for folks?
Absolutely. And diversification is a wonderful vehicle. So when we're thinking about concentrated stock positions, we want to be thoughtful of how big of a magnitude that stock position is. It can be a concentrated stock position that's material to that individual, or it can be a concentrated stock position that would be notable on the market. Fortunately, following retirement, after some time passes, individuals who are subject to SEC filing requirements will no longer have those reporting requirements, no longer have that transparency, and need the approval to make those transitions of the stock to diversify. But when we're looking at anyone who has a concentrated stock position with respect to their own portfolio, we want to think about options that can help uh, defer the tax consequences of that, along with finding that diversification they're seeking. And look at many different vehicles. So if we're looking at things like making gifts to family members or charity, actually going in and selling the stock, utilizing an exchange fund to help liquidate that and diversify a holding with other investors. There are so many different things that we can explore, but we really want to make sure it's thoughtful and relevant to that individual. Again, size and scope matters. It can be a concentrated position, and the general rule of thumb we like to say is over 10 or 15% of your balance sheet, that would represent a concentrated stock position. And we really want to be thoughtful and create a plan and execute on that plan. So
Yeah.
often we talk to executives that $50 is the price. That's when we're going to take an action. And then we get to 49 and the price goes up to 53 or 52 because they see that future potential as more information becomes available. So really finding a plan and sticking to that plan, and finding the opportunity to liquidate over time that concentrated stock position so that we're not continuing, especially as they have ongoing awards vesting, continuing to sort of add to that without making a meaningful approach on finding that diversification.
Right. And folks should be clear-eyed around how long this could take. If your concentrated stock position represents 70 to 80% of your portfolio, getting down to below 10% could take years.
It could, and we wanna look at if it's something that's that sizable, it could be something that we explore a more sophisticated strategy. Um, so we look at different options based on the individual, but it could take years. It's not something that we want to measure necessarily in months, because we want to you've taken time to accumulate that, have come in at different price points, and to the extent that it makes sense to do so, we'd like to exit in a similar fashion, targeting very specific markers, timing events, and things you want to achieve, all wrapped up into those decisions, all while trying to kind of manage the tax consequences to be as suitable as possible.
Yeah. Another benefit you mentioned earlier is health insurance. Many corporate executives retire with retiree health insurance, but I believe that there's some mistakes that executives could make regarding their retiree health insurance. I know in some cases, companies have eliminated retiree health insurance, and so maybe executives go in with one mindset saying, "I have health care throughout for the rest of my life," and then find out at some point that their company has terminated that plan. Talk more about how people can sort of deal with the healthcare issues.
I think we always want to look at healthcare as something that's a decision that we are revisiting on an annual basis. Does this make sense? Just because a company offers healthcare benefits to their retirees, it doesn't mean that that is the best option for that retiree to consider, given their health circumstances, given where they reside. There's some other factors that should come into play when looking at that, but it should always be viewed as kind of a periodic decision that we're going back and revisiting to make sure it makes sense. We first have to look at healthcare coverage up into the point of Medicare eligibility and making sure that we're making good decisions around that, utilizing the tools in the marketplace and understanding the difference. So, premiums are not all that matters. If you're used to having a very solid suite of professionals that you've worked with, doctors that you visited over the years, and you go with that less expensive policy, you may not have access to those same medical providers. So that should always be a primary driver in your healthcare decisions is having access to those doctors you need. But revisiting that over time and trying to find other options for healthcare just to make sure it makes sense and it still fits. And then
Yeah.
as you approach Medicare, considering whether it's traditional Medicare and a gap policy or if you're looking at Medicare Advantage. Some companies even offer benefits in that base of Medicare Advantage plan. There are lots of different options. There are great resources out in the marketplace to help evaluate those, including some of the SHIPS volunteers that may make sense to help you navigate those and understand the pros and cons of that. But it should always be an ongoing decision that may make sense for today, but maybe 5 years from now, your healthcare has changed and you may need to visit it and view it a little bit differently.
Yeah. Do you find executives sometimes shocked at the fact that when they were working, their health insurance costs were probably somewhat minimal compared to what they might be paying were they to go on original Medicare, add in Medicare Part B and IRMA charges, add in Part D and IRMA charges, add in a Medigap policy, and all of a sudden they're paying a lot more for health insurance than they did when they were working?
I think that is a big misconception. It's just the cost of coverage under Medicare altogether. With that income adjustment, as you suggested, it can mean a big difference in the premium from what is just generally talked about. So, layering on all of those additional pieces, again, having continued access to their preferred physicians, it can be a sizable number and might not be any less than what they were paying as an active executive, and sometimes a bit more.
Yeah. Amy, we
It's
have to take
important to have a good estimate of those.
Yeah. So, Amy, we have to take a short break, and when we come back, we'll talk more about the retirement planning issues that corporate executives face before they retire. Stay tuned. Welcome back to Decoding Retirement. I'm speaking with Amy Permenter. She is the head of corporate executive planning at Bank of America Private Bank. Amy, there's so much more to talk about when I think about corporate executives who are on retirement's doorstep, one of which is longevity planning. Oftentimes, folks in that type of position probably should expect to live a very long life, maybe into their 90s, 95, maybe even age 100. How do you help people think about how to manage and mitigate the risk of living that long and making sure that their money lasts that life over their lifetime?
One of the things we start with is just as you said, modeling retirement to a very mature age. Uh, Ideally, they are going to have plenty of assets to get to that age, but it's important to have that longevity and that duration built into the modeling. And in addition to that, with longevity, often comes the need for additional care. So we talk to clients about things like long term care, whether they are going to self insure and pay those costs themselves, whether they're going to look for outside insurance to help them supplement the cost of those needs over time, and just how they plan to approach it. We talk about the longevity that perhaps their parents experience to understand that so that we're actually building in reasonable assumptions and possibilities of what could happen. And especially if there is a need that could have a longer duration. So if we see things like in-home care that lasts for 3 to 5 years, that can have a sizable impact on their retirement. So we really do talk through that, understand what they're willing to accept in terms of that self-insurance or co-insurance, and then look to other alternatives. We
Yeah.
we should be talking about that, when they're 40, when they're 50. not just when they're at the door of retirement, because those those resources get incrementally more expensive if we defer that decision too long and may be unavailable. So it really is important to have that discussion when we're looking at retirement. Retirement isn't a one-time discussion. It's something that we should be doing over the years and refining and revising as more information becomes available to us.
Yeah. So when you think about long-term care planning, to me, it's not necessarily an either or. Either you self-insure or you buy long-term care insurance. It's in many cases a mix of both. That maybe you self-insure for the first 3 years, and then you have a long-term care insurance policy that kicks in at year 3 or year 5 or whatever the case may be. It's not necessarily that you're doing one or the other. It might be a combination of both.
Yes, and we're seeing different structures around long-term care than the traditional long-term care policies that we may once have looked at. So, life insurance with a long-term care benefit or a long-term care policy that has a life insurance benefit associated with it, so that it takes out that economic risk of loss if you have never have that event of needing the long-term care. But it also provides a little bit more flexibility in how those funds are paid. So whether we're having to go and request reimbursement or whether those payments are being automatically distributed to the family to help pay for that care when certain measures are met. So we really look to see what makes the most sense and what their situation is going to be. A single individual without children, we might take a different approach to someone with a large family with a number of children who may be able to help over time. So again, all of these come down to particular facts and circumstances. There's never a one approach to all circumstances with retirement or with any of these healthcare benefits that we're talking about.
Yeah, that is the thing I hate about retirement planning, Amy. There is no one size fits all answer to any of this. It depends, right? So,
Absolutely. And really working with an advisor to ask you those questions. What does retirement look like for you? What are your priorities? What is it going to cost you to retire? Those are all things that need to be factored in on an individual level and not just a blanket approach.
yeah. So, speaking of what things cost to retire and helping children, how do you help executives balance this need to fund their desired lifestyle? But also, in many cases, they might have large bequest needs that they might want to maximize their wealth transfer. How do you help them sort of navigate those waters?
And this is really a multifaceted question because we really want people to think about what does retirement look like to you? So a retiring executive will often see goes through a big transition. During their working years, they were flying on the corporate jet or flying business class or first class for travel, dining out on with a company provided card. What does retirement look like to you in terms of what the spending needs are going to be? So do we have real expectations of what those travel desires look like for you? What you're spending, and how those translate into your daily life, because that is sometimes an adjustment. So we want people to be thoughtful and have a very effective cost approach to retirement. What does it really look like for you? How do you envision it? And then secondarily, who else is on the payroll? Who are you helping in terms of your family? Oftentimes our kids come to rely on us in ways that we haven't anticipated. And it's sometimes difficult to shut that off. And that all impacts retirement spending. But when we get to the point where we see that we have enough, there's more dollars than there is need, even when we consider those extraneous things like long term care, it transitions into a discussion around legacy and wealth transfer. And how do we effectively do that? So, thinking through what specific desires are, what are their priorities? Is it education for grandkids? Is it providing a nest egg for their children? So if they're no longer there, having the assets to start a business, buy a home, do some of those things. So we try to be thoughtful around what that legacy is that they want to provide, both to their family and to their community. So looking at charitable bequests and how they want to integrate their overall wealth plan into a broader financial, charitable financial plan to help build their legacy in that way as well. So looking at donor advised funds, figuring out what those bequests should be both during their lifetime and at death so that we build that into the plan.
Yeah. So one of the more touchy subjects when it comes to corporate executives is the identity transition. They go from being a high-powered executive, that's who their identity was, to being a retiree. How do you help them sort of deal with that shift from what I once was to what I am now, which is a retired person?
And that can be a tremendous shift for individuals, especially with the audiences that they can command and the importance that they have from their roles. And we ask people to envision what retirement looks like. So how do they see themselves? What are their hobbies? What are the things that are going to take place of their daily work? Are they going to move into something like paid board positions for public or private companies? Are they going to spend their time volunteering? And do they understand that there could be financial commitments that come along with working with charities? What does that life look like to them so that they can redefine themselves? I've worked with many executives over the years that they retired, and after 6 months of playing golf, that's been fun, that's been enough, but they need to be back in that position where they're making impact on things, whether it's something small like their church, their community, or something bigger like other companies. So we really ask them to think through what those are so you don't retire and on day 4, you're trying to figure out what's next. This is a discussion that you have ongoing and trying to envision how your talents can be transitioned into that next role for you. And whether that's going to be something more toes in the sand retirement or something that's going to be my next chapter and how to be impactful in the world.
Yeah. So we have about a minute left, Amy. For executives who might be listening and who might be dilly-dallying with their retirement planning, what are the sort of the 3 most urgent action items they should take now in the next 30 days or so?
I would say try to get a handle on your benefits. Understand what's out there, what's on the table that you could be leaving behind. Have that discussion with your family, whether it's your spouse or significant other. What is it going to cost for us to retire? What does it look like? Sharpen your pencils and know what that vision looks like. And 3, run the numbers. And it's not a one-time thing. You should have run the numbers years prior to retirement, run the numbers approaching retirement as you've got more clarity on the situation, and continue to run those numbers over time to make sure that you have the flexibility built into your plan and you can adjust as needed so that you're not 10 years down the road and have to make a major adjustment that maybe you're not well positioned for at that time.
Yeah, and I suppose if you're in this position, having a financial advisor to turn to, if only as a sounding board, could go a long way toward making sure that you are comfortable in your plans.
That financial advisor will be your partner. They'll challenge you on questions. They'll ask you more about your benefits to make sure you really understand them and make sure they're modeling everything correctly.
Amy, we've run out of time, unfortunately, but I want to thank you for sharing your knowledge and wisdom with us and our viewers and listeners. It's so greatly appreciated. Thank you.
Thank you so much for having me. It's been a pleasure and an honor.
So check out more episodes of Decoding Retirement on your favorite podcast platforms, and we'll see you next time on Decoding Retirement.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.